Welcome back. Module 15, Option Strategies and Fibocan's Innovative Strategies. In Module 14, we have seen future strategies, how effectively it can be used to even invest in cash, and instead of investing in cash, how futures can be used as a strategy. In this module, we will be discussing about how options strategies can be done and also the Fibocan, our company's option strategies. As always, our LinkedIn profile, YouTube details, contact details and other details are given. So let's go. Target audience: MBA, CA, CFA students, intraday traders, derivatives particularly who are trading, they have to see and develop a sound knowledge. Takeaway: good understanding of option strategies and Fibocan's innovative option strategies, selling and buying. And lastly, dramatic transformation in investor confidence levels. So I have taken option strategies. 4 option strategies, as you can see here. Straddle, both long and short. Long means one who is bullish, who is thinking it will go up. Short is somebody who is bearish, which I have told earlier also, again repeating. So straddle, strangle, call spreads, put spreads. There are many more strategies that you will find in books and other practices, other things that are being in use, but these are some of the basics. Once you develop this, you can learn as many strategies as you want, but fundamentals has to be very strong and sound, which is why I have taken 4 simple strategies, easy to understand strategies. Particularly straddle and strangle is very easy to understand. We have taken with a simple example also. So long straddle strategy. So who is adopting long? As I said, it is buyers. So what they do, assuming that the current spot price, okay, futures is dependent on the spot price, that we know, right? Current market price of spot or spot price of a company or any stock or any commodity, will take stock, is 1000. So adopted by buyers, what they do, that means they buy options. What they buy? They buy both call and put option. That means they buy, of course, they have to buy the same underlying, same company stocks or same index, whatever it is, and same strike price, same expiry. Okay, why same strike price? Because it is at the money. When the spot price is at 1000 and you buy at the money, that is called long straddle. So you buy put option and call option 1000, strike price 1000, and pay a premium of 25 and 30 respectively. Net premium paid is 55. Why buyers adopt this strategy? They feel that, as you can see, I put like a train track where there is a range given. Okay, where I am not given the range, where there is a train track. You can see the both sides is closed. So why it is closed? They feel that there is going to be a good movement, extreme movement on any one direction. That is the expectation of the buyer. Okay, so buyers make profit only when there is extreme movement on any one side, either go up or go down significantly. If that happens, their profit is unlimited. Of course, there is no practical meaning of unlimited. Theoretically, we use the word unlimited. So what is the premium outgo? Because he is buying, he pays the premium to the seller of the option. 55 rupees is the total premium or net premium paid. Why? 25 rupees for buying the put option and 30 rupees for the call option. What is the profit range? As you can see in the box below, the break even, that is no profit, no loss for him, is either if on the expiry day the settlement price is happening either at 945 or 1055. Whereas if it happens anywhere below 946 to 1054 within this range, he is at a loss. Okay. Whereas you go to the top, 944 and below or 1056 and above, he makes unlimited profit as a buyer. So this is why buyers adopt this strategy. Why they adopt? Because they think that market will have extreme movement, but they are not sure which way it will move. So any one direction is going to help them, while in one of the option will expire worthless, the other option will save them. That is their intention. Now let's see short straddle. The same thing, same picture, excepting that he is selling the PE for 30 and he is selling the PE and CE for 25 and 30, right? Okay. So same strategy, PE for 25 and CE for 30 he is selling. Net premium received is 55. Why sellers adopt this strategy? Simple. They feel that it is going to be low movement or very less movement. That is why they adopt this strategy. Okay. So the profit for, we saw 944 and below or 1056 and above, extreme profit for the buyer, that is a loss for the seller and it is extreme, which is what we have to understand. Now let us look at the table, simple table. In slide 7 you are seeing break even, profit and loss using straddle strategy. As you can see here, various settlement prices I have given. Strike price 1000 we bought, okay. PE and CE, premium 55, 30 plus 25, that is paid by the buyer to the seller. As you know, it is a zero sum game, so if somebody wins, somebody loses. So the buyer has paid the premium to the seller. Let's see what happens. In scenario 1, if the settlement price happens at 1000 as the same as of the strike price, so buyer loses the entire amount. Why? Because he has paid the premium of 55 upfront and both the options expire worthless. So 55 is the loss for the buyer, which is the gain for the seller, which anyway he received upfront. Now let us look at scenario 2, 945. 945, what happens? The put option earns him 54 rupees. How? 1000 minus 945 is 55 is the profit, but he has already paid 55 for both the options, call option and put option, and hence his net profit is 0. So there is no profit, no loss, break even. Let's go to scenario 3. Scenario 3, if you see 1055. So in this case, the call option will fetch him 55 rupees because he will exercise 1000 rupees and 55 rupees is the profit. Put option expires worthless, hence his net is 0, break even. Let's look at scenario 4 and 5. Scenario 4, 900 rupees. Here again, put option earns him money, call option will expire worthless. Why? Because when he bought 1000 rupees and when the price is at 900, he can exercise only his put option, not this call option, right? So he will exercise his put option and get 100 rupees as the profit, and he has already paid an outgo of 55, premium outgo of 55, that has happened, hence his net profit is 45 rupees. If it is 750 rupees, if the settlement happens at 750, some reasons, these are all examples, please don't go into the logic of whether it will happen or not. It has happened many times in real time market, but that is not the issue here. Here we are explaining the concept. So 750 if it settles, then the profit is 250 rupees. How 250? 1000 minus 750, 250. And he has paid a premium of 55 upfront, so his net profit is 195 rupees. Let's go to scenario 6 and 7. So in this case, 1100 is the settlement price and 1200 is scenario 7 settlement price. In both the scenarios, his call option is going to earn money while his put option is going to expire worthless. Why? Because he has bought 1000, right to buy. So he will exercise this. Right to sell will be expiring worthless because the price is more, current price, settlement price is more. So call option earns him 100 rupees in scenario 6 and 200 rupees in scenario 7. How? 1100 minus 1000 and 1200 minus 1000. And the premium in both the cases, in all the cases he has paid 55. Hence his net profit is 45 in scenario 6 and 145 in scenario 7. So hence you can see here, this is the strategy adopted by both buyers and sellers. Whereas buyers earn unlimited profit, sellers earn limited profit, the profit that they earned upfront as premium. Now let's look at long strangle. Straddle we have seen, strangle. Strangle is nothing but an improvisation of straddle. That is what they say. Slide 8, as you can see the picture. Assuming that the spot price is 1920 and he is buying a PE at 28 rupees, 1910 PE at 28 and buying a 1910 PE at 28 and buying a 1930 put call option at 32. Why he is doing that? It is slightly different from straddle. Why? Because here he feels that the movement is going to be extreme and it will take care of such outside because he is buying out of money put option in both cases, right? Buying 1910 put option at 28 and 1930 call option at 32. Both are out of money when the strike current price, market price, spot price is 1920. So out of money, of course, premium paid is less than straddle, but the movement has to be much more than to make a profit because it is out of money. So either it has to go significantly much more than in the case of a straddle. So that is why we call this as a strangle. And profit obviously when there is extreme movement, but the movement has to be much more than that of a straddle. So as you can see, break even is 1850 or 1990, that is the break even, and any price below 1849 and below or 1991 and above, unlimited profit for him. So 1851 to 1989 is a loss for the buyer. Okay, So now let's see what is short strangle. Short strangle, as you see, is selling of 1910 put at 28, same price, and selling 1930 CE at 32. In this case, what happened? The seller is playing safe. He is selling out of money, call and put option both. So basically his intention is that one of it will expire worthless, the other one he expects there is going to be less or low volatility, and hence that also will earn him profit, or he has to shell out only a small part of the money, hence overall he is profitable. That is why he adopts. As you can see here, the profit in the case of buyers we are given 1849 and below and 1991 and above, that is a loss for him, and the loss is unlimited. That is the difference which you have to understand. Of course, break even for him is 1850 or 1990 if it expires settlement on that settlement day. Profit is 1851 to 1989, which was a loss for the buyer, is a profit for the seller. So now you understand it's a zero sum game. So slide 10, as you can see here, break even, profit and loss using strangle strategies. So the same example I have given. Let's see what happens. Settlement price 1910 and 1910 PE and 1932 CE. He has paid a premium, buyer has paid a premium of 60 rupees, 28 and 32 respectively. We have seen in the earlier slides. So let's see each of the scenarios. Scenario 1, when the settlement price happens at 1920, what happens? Both the options expire worthless. Why? Because he is having a 1910 PE, that is right to sell at 1910. He cannot exercise when the price is higher. So he is having a right to buy at 1930 higher, but the settlement price is lower. So that also will expire worthless. Hence the premium that he has paid upfront of 60, he loses everything. Let's go to scenario 2 on the left hand side immediately. Assuming that it expires on 1850. If it expires at 1850, his profit is 60 rupees. How profit? His put option earns him 1910 minus 1800, 60 rupees profit. Whereas he has already paid a premium of 60 rupees, so there is no profit or gain. Hence it is break even. So let us look at scenario 3 on the right hand side, 1990, 1990 if the settlement price. If it happens there, here the put option expires worthless because he has a call option at 1930, the price is at 1990, he exercises it and gets a profit of 60 rupees. He has already paid a premium of 60 rupees, so there is no profit, no loss. Now let's look at scenario 4 and 5. Scenario 4 and 5, the put option earns him while call option expires worthless. So what he earns, if it is at 1800, the difference 1910 minus 1800, it is 110, whereas he has paid a premium upfront of 60, the profit is 50 rupees. You can see clearly the working in the table. It's simple. Scenario 5, it is 1910 minus 1715, 195 rupees is the profit in the put option. Call option expires worthless. Premium he has paid, if you deduct it, the total profit is 135. Come to scenario 6 and 7, it is the same, 2075 and 2140. These are all some random figures we have taken, okay. And profit, call option is profit, put option will expire worthless. Simple logic, right? So 145 rupees is the profit in the case of 2075 and 210 rupees is the profit in the case of 2140. How? 2140 minus 1910. That is what, right? So that is the thing, okay, that is the profit. 1930, 2140 minus 1930, so 210 is the profit for him, okay. So in both the cases he has paid a premium of 60, hence the profit, net profit is 85 and 150 in scenario 6 and 7 respectively, right? Very clear, right? 2075 minus 1930 is 145, 2140 minus 1930 is 210, that is the profit. So this is the total net profit. So in this strangle, the seller expects less movement, okay, whereas buyer expects extreme movement, much more than a straddle, okay. So let's look at other strategies. Bull call spread strategy, which I said. Here the view is bullish, but using a calls spreads to implement this strategy. How? Let us assume that the spot price, as you can see in the picture, is 1250. So what the person is doing is that because he is bullish, he is buying 1250 at the money. He is confident that the price will go up at the money at 77, okay, because he is confident that the price will go up and hence he can exercise, okay. But at the same time he thinks that what if it doesn't go for some reason, Hence what he does, as a protection, he also sells a out of money. So when the price is at 1250 above, out of money, 1350 at 21. Hence his net premium outgo is 56 rupees. How? 77 minus 21. So obviously both options have to have the same underlying, which is the case, and same expiry date. Otherwise you cannot implement these strategies. That's a basic thing. So as you can see in the table below, the break even is at 1306. On the settlement day, if the settlement happens at 1306, he makes no profit, no loss. But if it settles below 1305 to any level below, 300, 100, his loss is restricted to 56 rupees. It is a loss but restricted to 56 rupees. If it is 1307 and above, any level, his profit is restricted to 44 rupees only, not more. You can see how. You will wonder. See the table, slide 12. As you can see, bull call spread strategy. So as you can see here, he bought the at the money call option at 1250 strike price by paying a premium of 77. Hence that is minus 77 we have shown. And on the option 2, sold out of money call option 1350 strike price and received a premium of 21. Hence premium received you have shown in plus. So now expiry at 1050, the first case. So what happened? Will this be exercised? It's a call option, right? So he has sold, right? Will this be exercised? No, he cannot exercise because it is at 1050. So when he will exercise? At least 1251, then only he will exercise. So his 77 paid is a loss for him. So in this one leg, 77 loss. In the other leg that he has sold for 21 rupees. Will that be exercised by the buyer? No. Hence he retains that 51. So net off is negative of 77 plus 21. So net his outgo, the premium outgo which he incurred at the outset, 56 rupees, is a loss for him. So same way you keep on going up to 1306 where it is a break even. Why it is a break even? When it is at 1306, his option that he bought 1250 he will exercise and he will earn a 57 rupees. But net off in that leg it is 20 rupees loss. Why? 77 rupees premium he has paid, but he has earned only 57 rupees. So 20 rupees is loss. In the other leg 1350, that will not be exercised. Why? Because it is 1306 whereas he sold at 1350, that is higher. So hence 21 rupees he retains within himself. 21 minus 21 is 0. Hence net outgo is 0, which is the break even. So same way you keep on going, and at 1900 we have just taken some random, any number you can think. You can even take 21,000, any number that comes to your mind, it will be the same. So 1900, what happens? His premium paid is 77 rupees he has paid. Whereas he gets a profit, killing, 650 rupees killing he makes. How? Because 1250 is the strike price, 1250 strike price he bought and settlement is 1900. So the difference is 650. Straight away he makes a killing of 650 rupees. And the premium he paid, if you deduct that, he makes a profit of 573 per lot. Oh, he is happy. But poor guy, on the right hand side what he has done, the option that he has sold at 1350, he is making a huge loss of 550. How? Why? 1900 minus 1350, that is the loss of 550. So whereas he has received a premium of 21 rupees only, if you deduct that, 529 is the loss. His profit is 573, his loss is 529. If you deduct it, 44 is the profit. Hence it is the maximum loss is also capped to 56, maximum profit is also capped at 44. Bull put strategy. So this is again bullish view, okay, but using a puts to implement this strategy. So what is it? The strike price is 1450. So what he does, he is thinking that the price will go up, okay, price will go up. So what he does is that, hence he sells a put option at a higher price. In the money put option he goes and sells, okay. He sells 1500 put, when the current price is at 1450, selling a put option higher price is in the money at 158. Whereas as a protection, what if it doesn't go? He buys a 1400 PE put option at 61 rupees as a protection. Hence net premium he receives 97 rupees. Of course, as always, see it has to be the same underlying expiry date, which I will not repeat again. It is selling of in the money put option and buying of out of money put option. Simple. Hence net premium received is 97. Break even, where he breaks even? 1403 he breaks even, right? And what is the loss for him? 1402 to any level below, it is a loss for him, but the loss is restricted to rupees 3. That's all. Any level you can think of. I have taken some examples, random numbers. Any level above 1404 is a profit, but the maximum profit is capped at 97 rupees. How? Why? See here. So option 1, he bought the put out of money put option. You see 1400 strike price, paid a premium of 61 rupees, right? And he sold in the money put option 1500 strike price and received a premium of 158 rupees. So now what happened? Think of at 990 when the expiry price, settlement price happens at 990. So what happened? He is making a profit by exercising this. He will obviously exercise, right? When the settlement is at 1990, he has a right to sell at 1400. Okay, the profit is 1400 minus 990, which is 410. But you detect the premium that he has paid in this leg, so 349 is the net profit. But don't be happy. On the other leg, he is making a huge loss. What is the loss? 1500 minus 990, which is 510 rupees loss. Of course, you detect the premium that he has received, 158. If you detect that, it is a 352 rupees loss for him. So net is incurring 3 rupees loss. Any level below you can go and any level above up to 1403. At 1403 what happens? It is a break even. So 1403 what happened? It's the option that is sold expires worthless, right? So it is 61 he paid, that's gone. Whereas the 1500 strike price that is exercised, 1500 price that is sold, that is exercised, hence incurs a loss of 97 rupees. The difference 1500 minus 1403, correct? So that is being exercised, hence he incurs a loss of, but still he goes on to make a profit of 61 rupees. How? 158 minus 97 is 61 rupees. So net, here he makes a loss of 61, the premium he paid, here he makes a profit of 61. So total it is profit for him. You keep on going, and at 15 and 10, that's the example again, you can put yourself as a practical example, you can put any numbers you want. At 1510 what happens? The 1400 strike price expires worthless, premium that he paid 61, that he loses. On the right hand side he come at 1510, okay, so that expires worthless. So the 158 that he received he retains, net off is retaining as 97 rupees. So that is the premium that he received at the outset. So as you can see, these are all strategies. Let's see bear put strategy. So what is bear put strategy? This is a bearish view, but only thing is that using a puts to implement this strategy. So spot price is 2430. So because he is bearish, what he is thinking is that he thinks the price will go down. Through 430 price will go down. Hence what he is doing is that he is buying a 2600 put at 124, so that no, he can make substantial killing. But at the same time, what if it doesn't goes? So what he does is that he sells a 2300 put well below. It's a out of money put option is selling, whereas he is buying in the money call option. Out of money put option 2300 he sells for 61 rupees. So net premium is how much? 63 rupees. How? 124 minus 61. So that is what he is paying. He is paying in this case because he is buying 2600 put at 124 but paying, but receiving only 61. Hence net outgo for him is 63 rupees. Okay. So what is the break even? As you can see from the table, 2537. If the settlement price happens on the expiry date, it's a break even. No profit, no loss. The loss, okay, any level below 2536 to any level down, it's a profit for him. What is the maximum profit? It is capped 237 rupees per lot by exercising this strategy at this strike price. What is the loss for him? Any close above 2538 to any level above is a loss for him. What is the loss? Restricted to 63 rupees. That is the maximum loss. Let's go to the table. So option 1, he bought in the money put option by strike price 2600. He pays a premium of 124. High premium he has paid. So option 2, what he did? Sold out of money put 2300 put option at 61 rupees. So when the price is at 1400, what happens? Yes, he makes a killing here. He goes and exercise. What is the profit? 2600 minus 1400 is 1200. So 1076 is the profit. But what is the loss? Because he has sold an out of money put option. That also is being exercised. The buyer is going to exercise because it is settlement is happening at 1400, whereas he has sold at 2300, settlement is below. Hence, the buyer of the put option is going to exercise, right? Okay. So what he does, he exercises. Loss is 2300 minus 1400, 900 rupees loss. So because it is 900 rupees loss, then what happens? 839 rupees net of loss he incurs. Okay, I have taken other examples also, 20, 2000, 2200, any example you can think. Okay, net of profit, you see here 1076 minus 839 is 237. So you keep on going for 2000, 2000 like that, you keep on going and you come at 2537. That is where the break even is. How the break even? When it is at 2537, okay, so the profit for him is 63 rupees because he exercised. Okay, it is 2538 is the current price. He has the right to sell at 2600. He exercises it. He gets a difference 2600 minus 2537, 63 rupees profit he gets, but net it is a loss for him. Why? Because he has paid 124 rupees as premium, whereas he is getting only 63 rupees. So 61 rupees is a loss for him in this leg. In the other leg he has earned 61 rupees, but that is 2300. So the 2300 strike price, so that is not exercised. Hence that is net it is a profit for him. Correct? Okay. Same way you keep going at any level, 2600. Okay, 2600. If you keep going, if you see here, the loss is 120. Why? Because he bought a strike price 2600. At 1400 he exercised. At 2600 he will not exercise. He cannot exercise. The 2300 sold. He has sold it, right? That also will not be exercised. Correct? That also will not be exercised. Hence, he is incurring a loss of 63 rupees minus 63. How it came? In the first leg 124 rupees loss. Second leg the 61 rupees he has sold. Okay, he has got 30 retains. The difference 124 minus 63 minus 61 is 63 rupees is the net effect of implementing this strategy. So as you can see here, so at various levels the loss and profit is capped. Let us look at bear call spread strategy. So the view is again bearish, but only thing is that we use calls to implement this strategy. Bearish means we expect the price to go down. Simple, right? Spot is at 3100. Because we are bearish, we expect the price to go down. So what we do is that sell a call option 2900 at 136, right? Sell a call option because that is in the money, right? When the price is at 3100, you are selling a call option below, that is in the money, 136, you get a better premium. And as a protection, what if it doesn't go there? So you buy a higher strike price, 3200 strike price, see at 38 rupees and you get a net premium of 98 rupees. So both buy an out of money call option and sell in the money call option. Simple. That is the logic. So 2998, if settlement happens, it is break even. So any price below 2997 to any level down, it's a profit. But profit is restricted to 98 rupees. Loss. About 2999, if it closes, it is a loss. Maximum loss is 202. Why? See the example. So he has bought a call option, right? Call option at 3200, right? And he has sold a call option at 2900. So let us assume that 1700 at number 1. At 1700, will this be exercised? No. Then that means the 38 rupees premium he paid will expire worthless. So 38 is the loss for him in the first leg. So yes, will the option he sold, will the buyer exercise this? No. Why? Because it is 2900 call option. The price is 1700. Hence, what happens? That will also go worthless. Hence, the buyer of the option will not exercise. The 136 we received, we will retain. Hence, the difference 136 minus 38, 98 is our profit. That way, any price up to 2998, 97 is profit and 2998 is the break even. So, come 2999, what happened? When it is at 2999, the strike price that we bought at 3200, will we exercise? Think of it. No. Why we will not exercise? Because we have a right to buy at 3200, whereas the price is at only 2999. So then that means we will not exercise. The 38 rupees we paid, that will remain there. it is worthless. Whereas we have sold 2900 call option, that means the buyer will exercise. At what price he will exercise? What is the profit for the buyer? What is the loss for us? 2900 minus 2999 minus 2900, which is 99 rupees loss. So in this leg, net of profit or loss is 136 minus 99 is 37 rupees. Still we are making a profit, but in the first option we have paid a premium of 38 rupees, hence net of we are losing 1 rupee. That way you keep on doing that. When the price goes to 3700, you see very clearly that we are incurring a loss, we are incurring a huge profit. We have paid a premium of 38, but we will exercise, we have bought a call option at 3200, we will exercise and get a profit of 500 rupees, right? 3700 minus 3200, so that is a profit of 500. So when you deduct that from the premium that we paid, 462 profit on leg 1. Now come to leg 2. What you have done? We have sold further lower 2900 call option. That means the buyer is going to exercise. So buyer will exercise at what price? What will be the 3700 minus 2900 is 800 rupees. So we already received a premium of 136, loss is 664. Here the profit is 462. Net loss is 202 rupees per lot. So this is how this strategy can be implemented. Thus all these strategies are in one way or other help manage and mitigate risk and also overcome any market challenges or any sudden up move or down move that happens in the market. Okay, so these are some of the excellent strategies that you will find in theory book and then many textbooks, and there are many more strategies. So now let us come to Fibocan strategies. So we have 3 strategies: SOFAR, SONIFAR and BOWMIDS. Let's start with SOFAR strategy on slide 19. So what is the difference? You might ask, no, what is that Fibocan is going to do something different? Yes, the only difference between all these strategies versus ours is all these strategies, Straddle, Strangle or the bull call, bull put, bear call, bear put, whatever strategies you have seen, these are all blind strategies, which is why somebody buys and sells both, somebody sells both, okay, or buying here within the range you buy and sell and all those things. But Fibocan strategy is very clear. We also do that, but only thing is that we have a clear understanding of the trading range. The number one point in our training programs is trading range. One has to identify the trading range through detailed technical analysis. Once you identify the trading range, then you can sell whichever options you want, whatever strategies you want to adopt. But we don't have such strategies where our profit is limited. We have our loss limited, but profit, we ensure that we get maximum profit because of our very good understanding of the trading range. So what we call so far is selling of options far away from the trading range. For that, what you have to do? You have to identify the trend and the trading range. The market is going up or going down, and within like a train track, from where to where it will go, market. And sell the options in the opposite direction or away from the trading range. As you can see in the first slide, spot at 32,900 and it is in a downward trend. The train is going from right to left, as you can see the arrow. So we find that the trading range is going to be 31,000 to 35,000. Okay, what we do is sell CE 35,700. It's a very safe, but only thing is that you will get very less of premium. Okay, so it's again a trade-off between risk rewards. So this is one strategy, right? This is so far is one strategy, but clearly we identify the trading range and we know for sure that the track is laid between this point to this point. So we are outside the track on both sides. Same way, the trend is up. What do we do? The trend is up. In fact, in the first case also, you can sell a PE below 31,000. That also can be done. In the second strategy, in the second picture you see, spot at 32,900, the trend is going up. Assuming the trend is going up, the trading range, as you can see here, same the range, 31,000 to 35,000. What do we do is that we will sell a PE of 30,500. So if the train is going this side, we go in the opposite direction. If the train is going this side, we go in that direction. This is the strategy we adopt. But for that, we need to understand train stops where, from where to where it goes, and where to where it will come back, and again where it will go up, and again will it come back. What is the range within which it will operate? Once you understand this, this is the simplest and easiest strategy to make. SOFAR. SOFAR is what we call it as selling of options near yet far away from the trading range. What it means? We sell very close or even before. Okay, it's a high risk strategy. Identify the trend and trading range. Sell within the trading range against the movement of stock and index. Higher risk, higher return, but it gives a higher risk and higher return. How? You see the examples here. So what we do, trading range 31,900 to 35,100. The first slide, top slide you see here, slide 21. So trend is moving down, spot is 32,900, trend is down. So what do we do? You can see three things. SOFAR dynamic at 33,000 CE and SOFAR assertive at 34,000 and SOFAR aggressive at 32,200. So if you know that it is current price is at 32,900 and it will go all the way up to 31,900, if you are sure. That is why you have to identify the trend and range. Then you can adopt any of these strategies. In SOFAR, we sell outside the trading range. Here we sell within the trading range. Where we want to sell, that is our choice. For example, if somebody is assertive, she can sell at 34,000 CE, right? Because that it is going down. Train is going this side, we sell the CE, we follow the train. Somebody is assertive, they can sell very close, 32,900 the price, we sell at 33,000, slightly here. Somebody is very aggressive, okay, he wants a very high reward, he can sell at 31,900 because he is sure that the train is going towards that direction. So that way, the profit can be maximized depending on the risk appetite. Of course, thorough understanding of the range. The other way around, in the below picture you can see spot at 32,900, same thing, trend if it is going in the upward direction. Okay, so again, SOFAR dynamic, as I said, 32,800 PE can be sold. SOFAR aggressive, 34,500 PE can be sold. In SOFAR aggressive, 34,500 PE can be sold. SOFAR assertive, 32,300 can be sold. Because the train is going this side, you are here. Somebody is near the train, somebody is near the engine. They know that the train will cross there and they can make good money. So these are some of the strategies of selling. So buying of strategy, what do we do in buying? Buying of options within the trading range, but will move in the direction we predict significantly. What do we do here? Again, identify the trend, significant trend and trading range. Buy options along the trading range, wherever you want. In the money, at the money or out of money can be bought based on the expected returns and premium outgo. You can see the BOWMIDS strategy. You see here in the top slide. So when the trend is going down, you buy an option, buy a put option. Okay, if somebody is 32,400 put option he can buy. So he feels that okay fine, I pay less premium. 33,000 put option, somebody pays slightly more premium than this 32,400, and 33,600 PE, they pay a very high premium, but it is a risk. But if it goes in the trend, there is a huge reward, right? Risk to reward. In the below picture, it is the same. Spot at 32,900, but the price is going up. Here, you buy the CE. So somebody who can buy at 32,000 CE, so he will pay a higher premium. Somebody at 33,000, he will pay less premium than the 32,000 CE, and 35,000 CE, 33,700 CE, he will pay even less premium than this 33,000 CE or 32,000 CE. Because we know that the trading range is 31,000 to 35,000 and the market now it is 32,900, it will go up to 35,000, hence even at 33,700 we will make money. That is why we adopt this strategy. But whatever it is, so what one has to develop is a very good understanding of the concepts, understanding of the market and a detailed understanding of the technical analysis, without which it is all a blind strategy. Few times we will win, but in one or two times market is market, it is supreme, it will take away our entire profits. Thank you very much.